CNBC TV18, celebrating 15 years of leadership.
The Reserve Bank Governor has announced the first rate cut after a gap of 20 months. The guessing game now is how many more rate cuts can we get. Our effort today is to understand what is the appropriate rate of interest for India. A key problem for India in the past 5 years of double-digit inflation was that nominal interest rates remained below inflation rates, leading to a huge drop in financial savings and a flight to gold and land and other assets. Savings can rise only if a saver gets a real return. That is, nominal interest rate minus inflation must be positive. But how high must the real interest rate be? If nominal rates, that is the repo rate, is at 7.75 and inflation is expected to be 5.5% average in 2015, that gives a real rate of 2.25%. Is this too high? Will savers be content with a 1% or with a 2% real rate? That is the question we are asking today. And to answer this question, we have with us Dr. Rangarajan, former Reserve Bank Governor and the proven inflation warrior in India. Also, Jahangir Aziz, Chief Economist, JP Morgan. A little later in the show, we will be joined by Eswar Prasad, Professor of Economics from Cornell University, who will give us a cross-country perspective of real rates. Dr. Rangarajan, you first, sir. What do you think should be the real rate in India? Will savers be content with 1%?
Well, there is no easy way of determining it. There is a proof in economic theory that in a purely closed economy, the real rate of interest can be equal to the real rate of growth of the economy. Therefore, it can go as high as that. But this is not valid in an open economy. That holds good purely in a closed economy. Everyone realizes that the savers particularly need a real rate of return on their deposits or on their assets. Therefore, in some sense, it depends upon the level of savings that one wants to have in the country. If the demand for savings is much higher, then obviously we should be willing to pay a much higher real rate of interest. I certainly think that the Indian investor is looking, or the Indian saver is really looking for a real rate of return which is about 2%. I mean, I think it is closer to 3%. I mean, this is again a guess. There is no way of purely determining it. But if we want actually a higher level of savings in the economy, we should work towards something like close to 3% real rate of return as far as the financial assets are concerned. Well,
in that case, Dr. Rangarajan, if the informed guess of average inflation for 2015 is 5.5%, then your 2.5% would mean that we are already not giving a very good real return at 7.75%. At least we should not give too many more rate cuts, lest we scare away savers.
No, I think that the average of 5.5 is something that we need to recheck. In fact, all the projections of the Reserve Bank of India on this score have gone awry. In fact, the inflation rate today is way below the glide path that was indicated. Therefore, one could expect the inflation rate to be somewhat lower than the number that you are talking about. After all, if you look at it in terms of the wholesale inflation, that is fairly low. And I do not think that probably we are looking for 5.5% in the coming year. I think it will be lower than that. And therefore, I think that further cuts in the repo rates are possible. Anything should be done in relation to what is happening actually at the ground level. My own expectation is, given the way in which inflation has behaved in the recent period, perhaps we might be closer to between 4.5 and 5% on an average. And therefore, that gives you, even if you have a 2.5% real rate of interest, something like 7%. Therefore, there is certainly a leeway to go. I mean, I think there is a possibility of further reductions up to a total of 100 basis points during the year.
Fair enough. Jahangir, is there a real rate which is common across countries?
No. Because your real rate is essentially determined, as Dr. Rangarajan said, more or less in the medium term by your real growth rate.
Okay.
So if your real growth rate is higher or lower, did the same. Now, all of this the nominal rate obviously will equalize across countries if you have open capital markets, which means that your inflation adjusts so that your real rate and your real growth rate more or less has some sort of a relationship over a average over the medium term.
Okay, so now let's come to India. What would you say is a real rate, a good real rate for India?
So the way in which we would want to look at this thing is that let's pick up a time period in India where we think things were stable. And, I want to use the word normal, but just can't use the word normal, but, more or less stable, right? So you had really, decent growth rate. You had a pretty stable inflation rate. The current account deficit did not blow up. The rupee, more or less was stable, etc. So broadly, we're talking about that period, 2003 to 2007, not even 2008. And if you look at that period of time, look, potential growth probably at that time was about 8.5%. And if you look at real policy rate at that point in time, that's where you get that 200 basis points or 2% real rate, right? That's where you want the policy rate to be. Without going into 5, 5.5, what will be next year's interest rate, let's take 6%, which is their target, and 4%, which is their target after 2016, which is where they really want to be.
Yes.
You take an average of 6 and 4, you get that over the medium term, if RBI is more or less manages to keep inflation expectations under control, they will keep inflation around 5%. So that's where you get a 7% nominal policy rate. No, 2% real plus 5% inflation, that gives you a 7% nominal policy rate.
Fair enough.
You're at 775 now?
Yes.
The question becomes, Latha, is that do you want to give the entire 775 now? 75 basis points now? Or do you want to even give more than 75 basis points? In other words, you want the real rate to be even lower. Why? Because growth is actually lower than the potential growth rate right now. Hoping to make it up later on.
Yeah.
So
Jahangir,
that's the way you calculate it.
Let me get Dr. Rangarajan's response on this, sir.
I think when you talk about the real rate, I think there is not one single real rate. You are talking about the real rate for the policy repo, and there is a real rate for long-term savings. When I talked about 3% as the real rate of interest, I am thinking in terms of the long-term savers.
Okay.
Whereas the repo rate is basically a rate which is a short-term interest rate.
Yes.
Therefore, I think we need to make a distinction between the real rate of interest for a short-term transaction and for a medium-term and long-term transaction. Therefore, 3% real rate of interest for savers is I think appropriate, and perhaps the policy rate need not necessarily have a 3% real rate of interest.
Dr. Rangarajan, one more question, since you were instrumental in bringing down the inflation level from double-digit levels in your own time. The Reserve Bank has taken a fairly ambitious target of 4% inflation as suitable or possible for India. If you compare this to the historical rate of inflation in India, the average of 70 years is 7% if you looked at the WPI, almost 6.9%. And if you looked at CPI industrial workers, then the average has been actually 8%. Do you think it's too tall a ask of 4% that the Urjit Patel report has set for next year. Is the political economy too comfortable with that 7% inflation, and therefore it will resist 4%?
There are two types of answers to your question. First is that the very high inflation rate that you have got, or that you have calculated, is over a very, very long period. And there was a period in the Indian history, in the post-independent period, when many people talked about inflation almost being endemic in economic growth. It is this which led to very sharp increases in prices. You remember in mid-70s, the wholesale price inflation not only touched double digits, it went almost up to 20%. Therefore, those days are gone. And if you naturally look at after 92, 93 or 93, 94, the level of inflation is much lower on the wholesale price index. Therefore, it is possible. And the other answer is that while 4% is the desired level, the argument is that it could range in a zone of 2 to 6%. 2%, let us leave it out. I think let us look at the upper end of the zone. It is 6%. Therefore, strong action is required when the inflation rate actually exceeds 6%. Therefore, I would think that, yes, 4% is the most desirable level, but actually strong action is required when it exceeds 6%. And if you look at it that way, I think I do not regard the target set as being ambitious, and I think it is most desirable to achieve it, because world over the inflation has come down, and India cannot be an exception to that.
Okay. Well, Jahangir, my question is, the political economy appears to be comfortable with a 7% inflation. So will it resist actions towards 4%?
And my guess, Latha, is that 7% inflation rate with which the political economy, quote-unquote, was comfortable with was when growth was also 8.5%.
Okay.
You now no longer have the luxury of 8.5% growth rate. So that, real incomes were pretty large and growing very fast. But if your real growth rate is now down to 6.5%, I really don't think that the same population would now be willing to live with a much higher inflation rate than, let's say, 4 or 5%.
Fair enough. We are out of time. Dr. Rangarajan, Jahangir, thank you very much for taking us through this very erudite explanation of what might be the correct real interest rate for India, and therefore academically and theoretically how many rate cuts can we legitimately expect or should desire in the current situation. Thank you very much for joining me. Well, that's one part of the discussion. After the break, we are joined by another guest, Eswar Prasad, the Professor of Economics from Cornell University, on the same issue, what's the appropriate real interest rate for India?
CNBC TV 18, celebrating 15 years of leadership.